The American dream is facing its greatest threat since the 70s, as stagflation looms over our economy, threatening to erode decades of wealth building for homeowners and investors alike. What took you 30 years to build could be decimated in just 24 months if you don't understand and prepare for the economic perfect storm that's brewing right now. Welcome to today's analysis, where we're diving deep into one of the most concerning economic developments of 2025, the growing specter of stagflation. I'm speaking directly to you, the experienced homeowner, the seasoned investor, the wealth builder who's weathered economic storms before. But this one might be different. For those of you who remember the 1970s, the word stagflation likely sends a chill down your spine. For those who don't, you're about to understand why this economic phenomenon keeps economists, investors, and homeowners up at night. Stagflation is the economic equivalent of being caught between a rock and a hard place. Stagnant economic growth combined with persistent inflation and rising unemployment. It's a triple threat that defies conventional economic solutions and can devastate unprepared investors. Let's start with the hard facts. Yardeni Research recently increased their probability assessment of the U.S. entering a stagflation period to 45%, up from 35% just months ago. This isn't speculative fear-mongering. It's based on concrete economic indicators that are flashing warning signs across the board. The Federal Reserve has already lowered its 2025 economic growth forecast to just 1.7%, down from the previous projection of 2.1%. Meanwhile, the Federal Reserve Bank of Atlanta's GDP Now tracker is showing negative growth of 2.8% in the first quarter of this year. Let that sink in. Negative growth while inflation persists. Speaking of inflation, despite the Fed's aggressive interest rate policies over the past few years, inflation remains stubbornly above target. The central bank's latest projections forecast year-end PCE inflation rising to 2.7% before eventually reaching its 2% target by 2027. That's a long road ahead, with inflation eating away at your purchasing power every step of the way. What's particularly alarming is that consumer expectations for the economy have hit a 12-year low according to the Conference Board's Expectations Index. When consumers lose confidence, spending decreases, businesses pull back, and the economic cycle can quickly spiral downward. The parallels to the 1970s are impossible to ignore. Back then, inflation ran rampant. The Federal Reserve hiked interest rates aggressively, and the housing market stagnated. The decade became synonymous with stagflation, an economic cycle that dragged down the economy for years. Mohamed El-Arian, chief economic advisor at Alliance, recently warned that an intense period of rising interest rates, high oil prices, and a stronger dollar is pushing the financial market consensus on U.S. economic growth away from the comforting notion of a soft landing. He further cautioned that there is a material risk of this leading to higher inflation for a broader range of goods and services. For homeowners and real estate investors, stagflation presents unique challenges and considerations. Let's examine how the current economic conditions are affecting the housing market and what might lie ahead. Currently, the MBA 30-year mortgage rate stands at 6.71% as of April 2025, while Fannie Mae projects rates to end 2025 at 6.3% and 2026 at 6.2%. JP Morgan maintains a more conservative outlook, predicting rates will remain above 6.5% throughout 2025. Compare these rates to the historical averages of 4.92% for new mortgages since 1998, and you can see we're in a significantly higher interest rate environment. These elevated rates have profound implications for the housing market. Higher borrowing costs reduce purchasing power for buyers, slow transaction volume, and put downward pressure on home prices in many markets. During the 1970s stagflation, the housing market experienced precisely this pattern. The central bank's measures to tame inflation drove up borrowing costs and ultimately shrunk home buyers' purchasing power. The current housing inventory situation adds another layer of complexity. While we're experiencing a housing inventory shortage with a supply gap estimated at 6.5 million homes nationwide, stagflation could paradoxically both worsen and mask this problem. As Roger Valdez noted in Forbes, with higher interest rates, people won't be buying new homes and sales will slow. This means builders and investors in housing will back off new projects, both single-family and multifamily. This pullback in construction creates a dangerous scenario. When the economy eventually recovers, housing will be even more scarce than it is today, potentially leading to dramatic price increases down the road. It's a classic case of short-term pain creating long-term supply constraints. For current homeowners, particularly those who secured fixed-rate mortgages at lower rates, there's a silver lining. Fixed-rate mortgage debt becomes less burdensome in inflationary environments, as the real value of the debt decreases while the asset, your home, typically appreciates with inflation over time. This is one reason why real estate has historically been considered an inflation hedge. Another concerning trend is that attitudes about home ownership have been changing, especially among younger generations. Many no longer view owning a home or having a mortgage as realistic or even desirable. This shift, combined with persistently high interest rates, could lead to falling home ownership rates over the rest of the decade. For rental property investors, there are mixed signals. Zillow and Zumper report that rents are flattening and even falling in some markets. This trend could continue as economic uncertainty grows, potentially leading to higher vacancies and reduced rental income. For those over 45, stagflation poses particular threats to financial security that younger individuals may have more time to recover from. First and foremost, stagflation erodes purchasing power at an alarming rate. When inflation outpaces wage growth, a defining characteristic of stagflation, your dollars buy less each month. For those approaching retirement or already retired, this creates a dangerous scenario where fixed incomes become increasingly inadequate to cover rising costs. Consider this: Americans currently owe $12.61 trillion on 85.1 million mortgages. That enormous debt burden becomes increasingly difficult to service when economic growth stalls and employment becomes less secure. For homeowners in their peak earning years, job loss or income reduction during stagflation can quickly transform a manageable mortgage into a financial crisis. Retirement accounts are particularly vulnerable during stagflationary periods. Traditional fixed income investments like bonds, which many investors shift toward as they approach retirement age, typically perform poorly when inflation rises. Meanwhile, stock markets often struggle during periods of economic stagnation, creating a scenario where few traditional investments offer adequate protection. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Housing wealth represents a significant portion of net worth for Americans over 45. According to recent data, home equity accounts for approximately 66% of the net worth for the median homeowner in this age group. A stagflation-induced housing market downturn could therefore have outsized impacts on your overall financial picture, potentially derailing retirement plans or forcing difficult lifestyle adjustments. For those counting on selling their homes to fund retirement or downsize, a stagnant housing market presents another challenge. Reduced buyer demand and higher interest rates can extend the time it takes to sell a property and potentially reduce the proceeds from the sale. While stagflation presents significant challenges, history shows that informed investors can find opportunities even in difficult economic environments. For experienced investors, several strategic approaches merit consideration. First, real estate remains one of the most effective inflation hedges available. During the 70s stagflation, while many investments struggled, real estate generally maintained its value relative to inflation. The key is understanding which segments of the market offer the best protection and growth potential. Fixed-rate mortgage debt, as mentioned earlier, becomes less burdensome in inflationary environments. The real value of your mortgage debt effectively decreases as inflation rises, while the underlying asset typically appreciates. This creates a favorable leverage scenario that few other investments can match during inflationary periods. For those with available capital, market downturns often create buying opportunities. As other investors retreat from the market due to uncertainty or financial constraints, properties may become available at more favorable valuations. The housing supply gap of 6.5 million homes hasn't disappeared. It's simply been masked by current market conditions. When demand eventually returns, those who acquired properties during the downturn may be well positioned to benefit from appreciation and increased rental demand. Income-producing properties deserve special attention during stagflationary periods. While growth investments may struggle, cash flow becomes increasingly valuable. Properties that generate positive monthly income can provide financial stability during uncertain times and potentially allow for additional acquisitions as opportunities arise. Diversification within real estate becomes particularly important. Different property types and locations will respond differently to stagflationary pressures. Residential properties in areas with diverse employment bases, multifamily properties in supply-constrained markets, and industrial properties supporting essential services may offer better protection than retail or office properties in oversupplied markets. Now that we've examined the threats and opportunities presented by stagflation, let's outline specific actions you can take to protect and potentially grow your wealth during these challenging times. 1. Evaluate your debt structure. Fixed-rate debt at reasonable interest rates can be advantageous during inflationary periods. Consider refinancing variable-rate debt to fixed rates, even if current rates seem high by recent standards. 2. Access your real estate holdings. Are your properties positioned to weather stagflationary pressure? Properties with strong cash flow, low vacancy risk, and minimal deferred maintenance will generally perform better during economic downturns. 3. Build liquidity. Market downturns create opportunities, but only for those with available capital. Begin building a strategic reserve that would allow you to act decisively when others are forced to sell. 4. Diversify within real estate. Different property types and locations will respond differently to stagflationary pressures. Ensure your real estate portfolio isn't overly concentrated in a single market or property type. 5. Explore inflation-protected investments. Treasury inflation-protected securities, TIPS, I-bonds, and certain commodities can help protect portions of your portfolio from inflation. 6. Develop multiple income streams. Job security often decreases during stagflationary periods. For those still in the workforce, developing additional income sources can provide financial stability if primary employment is disrupted. 7. Adjust your timeline expectations. Stagflation typically extends the time required for investments to mature and properties to appreciate. Adjust your expectations accordingly and ensure your financial plans can accommodate longer holding periods if necessary. As we've explored today, stagflation presents a complex set of challenges for the economy broadly and for real estate investors specifically. The combination of stagnant growth, persistent inflation, and employment concerns creates an environment that few active investors have navigated before. The warning signs are clear. Yardeni Research's increased probability assessment of stagflation, the Federal Reserve's downgraded growth projections, negative growth signals from the GDP Now tracker, and consumer confidence at 12-year lows. These indicators, combined with the historical parallels to the 70s, suggest we're entering a period that requires careful navigation. For the housing market, the implications are significant. Higher mortgage rates, reduced buyer demand, and potential construction slowdowns could create short-term challenges but also lay the groundwork for future opportunity as supply constraints intensify. Yet within these challenges lie opportunities for informed investors. Real estate's historical performance during inflationary periods, the advantages of fixed-rate debt, and the potential for strategic acquisitions during market downturns all merit consideration as you develop your investment approach. The American dream isn't dead, it's evolving, and now those who understand the economic forces at work and adapt accordingly will be best positioned to preserve and grow their wealth even as stagflation sparks new fears for the U.S. economy. Thank you for joining me for this analysis. Remember, in times of economic uncertainty, knowledge and strategic action are your most powerful tools. If you found this video interesting, please subscribe, share, and watch this one as well.